In this video, I'm going to talk about, from a conceptual point of view, what a dividend is. So you've probably heard the term before, and I think to explain it, it's best to return kind of to our original accounting equation and think about assets being equal to liabilities and equity and what that really means. So we've got the assets of the firm, and then we've got the debt that we have in the firm, the things that we owe to others, and then we've also got this equity component. Now that equity component is where dividends come into play. So dividends are a distribution from equity. Distribution from equity. So when we think of equity, think of when you start a company. You start a company, so you have some company A. You decide you want to start your own corporation, and you invest, let's say, $1,000 of your own money. Right now, that becomes equity. Now you go and you make money. Let's say you make $25 the next year, you make $35 the next year, and the equity keeps growing. And so pretty soon, now we've got 1,060. Right now, when you go and you issue a dividend, you're paying the equity back to the owner. Now, in the case of a company run just by you, you're paying it to yourself. Not in the form of a salary, but in a different sense. But let's assume for a minute there are multiple shareholders in this company. And so you've got 1,060 in equity, and you want to pay some of this to the shareholders. You want to give some of it back. So you've made some profits, and you're saying, okay, I want to give you some of this 25 or some of this 35. Now, sometimes the company might decide they want to keep that money. They think that they can invest it or something like that. They can make some investment. Hey, hold on to it. We'll make you even more money. Just let us keep this money. We've got a great investment. But if they don't have anything like that, they could just say, okay, well, we'll just distribute this money back to you. We'll just give you some of these profits. And so that distribution is a dividend. And we commonly think of cash dividends, but it doesn't have to be cash. They could give you a bottle of wine. They can give you whatever they want. So they're distributing back to the shareholders. So when we think of dividends of the profits, that's normally what we're thinking of. But what if they decide that they want to give some of that 1,000? What if they don't have any profits? What if they've had losses? Or what if they've already paid out this $60, this $25, and this $35? What if they've already paid that out and they don't have that to pay out anymore? And all that's left in equity is just that 1,000. So you think of equity, you've got this pool, right? And you've got contributed capital. That's that $1,000. That's just money that was just given by investors. That's the contributed capital, right? But you also have retained capital or retained earnings. That's that 25, the 35, that's all the profits that were made. But what if the retained has already been paid out? Or what if there never was any retained? Can you pay out a dividend of that contributed portion? And the answer is yes. Yes, you can pay that out. And what is that going to be called? Well, that's called a liquidating dividend. And it's called liquidating in the sense that you're returning an investment. So you're returning that contributed capital, returning the investment to the shareholders. So now we can pay out the profits in a normal dividend, which when you typically hear of a dividend is basically just someone paying cash, saying, okay, we made some money, we made $25, and now we're going to give some of it to the shareholders. But if we don't have anything and we just want to give money for whatever reason, it's a liquidating dividend. But we can also think about, like, in terms of journal entries. Well, what happens here? So when we have a journal entry and we actually issue or declare the dividend, we're gonna debit retained earnings, assuming that this is coming out of our profits. This is coming out of this retained portion, profits that we had in the past. We're going to debit retained earnings. So let's say we have a dividend of $10. So we debit retained earnings, and then we're going to have a credit to dividends payable. And then when we go ahead and actually pay out that cash, then we'll just reverse. We'll debit dividends payable, and then we'll credit the cash. But we're debiting retained earnings because retained earnings is decreasing. So if we can think about it in terms of our assets equals liabilities plus equity, let's think of it like this. Let's say in our example that the firm had $100 in assets equal to, let's say, $40 in liabilities plus $60 in equity. And then you have this dividend of $10. So what happens to the assets, to the equity, and everything? So what's going to happen is this. We're going to go, change color. We're going to go down to 90 in assets, 40 in liabilities. That stays the same. And now we've got 50. Because we paid out, we're paying out $10 cash or $10 in wine or what have you. We're having a decrease in equity because our retained earnings, we're paying out some of our retained earnings. So retained earnings is going down. And retained earnings is part of equity. So equity is going down. And then we have a corresponding decrease in assets. We pay out the cash or the wine or whatever. So that goes down as well. So that's what happens when we have this dividend. We're basically taking some of the equity that we've either earned or maybe that was just given to us, and we're just paying it back to the shareholders in the form of cash or something else.